right, welcome everybody. Shane Carter here, Hampshire Capital. Along with me, as always, our VP of Investor Relations, Eddie Austin. How's it going,
Hello,
Eddie?
everyone. Man, it's going great. Nice day.
Yeah, it
Sun's
is.
shining. It's an exciting day. We got a new fund getting ready to come out. Man, we got to talk about this. $50 million, Hampshire Capital Fund 1,
Yes.
506C, accredited opportunity, structured for the reason to buy multifamily assets.
That's
Let's
right.
talk about it.
Let's talk about our new fund. We're excited about it. By the time this video lands, our fund will be just about live or live as well. And we'll put a link somewhere in this video for folks to be able to find out more about that. But yeah, Eddie, why don't you launch us off? Let's talk about the fund top level. What is it? How does it work? Why
absolutely.
is it a good investment? So on and so forth.
So, we've done syndication for a while. We bought some nice properties, 2,300 doors under management, but we wanted to scale, right? We really wanted to get a lot bigger. We wanted to do it a lot quicker, and we wanted our investors to have a better opportunity to invest in something. And, we decided to drive upon a 506C fund. This 506C fund is for accredited investors. At this time, we'll be able to bring in, institutional money, retail money, which the retail money we really care a lot about because those are the people we're really trying to help, right? And with that, we can bring in someone with a $100,000 investment, a $250,000 investment, or even a $1 billion investment, $5 million. It's all fine. It's all the same type person. All we want to do is get this out to enough people to where we can truly help those retail investors. At the same time, we work with a lot of institutions. So, I'm pretty excited about it because it's the first offering we have that we can kind of commingle everybody in together, and the returns are just altogether good. The best part about a fund, though, is the diversity. We're going to probably, at minimum, close 2 deals inside this one fund. So, hey, one takes a little bit longer on the value add strategy, and the other one's a good one right out of the gate. Hey, like Claybrook Commons, the one we're closing here soon, that deal right there, it's cash flow day one. Mm-hmm. So if we buy that particular property or one just like it, and then we buy a value add strategy, that value add strategy maybe takes a little longer to get the cash on cash up. Hey, with a fund, if 2 properties are closed within inside of that, you're going to see cash flow. Yeah. That 8 pref, the waterfall, everything works.
Yeah, so what you're saying is that one of the many benefits of the fund model is that you're not simply relying upon the returns for any given investment, but rather you get a blended return for all of the investments that are in this fund. So to your point, we might have a 2022 build, A-class asset that has a great cash-on-cash return and is cash flowing day one, doesn't really have a value-add component. There's maybe a roll to market or a lease trade-out play that where we're getting great lease trade outs versus Gen 1 sort of lease up dollar amounts, and so that's a nice arbitrage and that grows the cash on cash. But it's sort of what we call a coupon clipper, right? Where it doesn't have a huge equity multiple, but it's got a great cash on cash, and you marry that with maybe 1 or 2 different value add plays that don't really have cash flow for the first year or year and a half while we're implementing the value add program. But we raise that value so much, we get the NOI to jump 50% in the first 3 years, and we have a really strong equity multiple growth story. So you're getting a blended return of the cash on cash from some stabilized assets and the equity multiple returns from value add deals.
Right. So the normal thesis around a fund model is you have a harvest period. What is a harvest period? A harvest period is the time that you're going to raise money. Because we are so active in the space and because we're diversified in the market, our harvest period is not going to be nowhere close to a year. And normally what people think about a fund is, I don't want to put my money in a fund because they're not going to actually deploy that money into the market for a year. It's not true with us. We're a type of company, we're actively looking, we're extremely connected in our deal flow. And we are looking at deals every single week, 2 to 3 deals a week that are serious deals.
Yeah, we wrote LOIs last week. Nick, our business partner, is flying out to Dallas tomorrow. We're going to make some more LOIs this week. We are very active in the market. That's true.
Right. So that harvest period is now nowhere close to a year. We're going to raise this money as fast as possible. I know we've had my running joke that I'm going to raise this $50 million in a month. We're going to do the best we can. Absolutely. And then we can expect to truly put your money to work as soon as possible. As soon as we can put it in an asset, it's going to happen.
Yeah.
3 to 5 year lockup, meaning 3 to 5 year your money will be deployed into the market with the ability, if we want to, because the market's just not there yet, and the asset hasn't matured, we can hold up to 10 years, and we'll send out letters to everybody on that. But with that, we do not anticipate refis at this time. And Shane, why do you feel like that?
Well, it's just we just like to be sufficiently conservative, right? So if we underwrote and did a pro forma based upon a 3-year refi, that's going to have a return of capital event. It's going to have a massive IRR and cash on cash drive in year 3. That's going to affect the overall IRR metrics and return metrics that the investor is going to receive. And we like to allow ourselves the options to do that, but that's not in our underwriting, right? So we underwrite to a straight 5-year hold. And that way, again, we're providing ourselves with sufficient conservatism to not overpromise, right? So I don't, even 6, 12, 9 months ago, you were seeing a lot of syndicators that were, their business model was refi in 3 years. Well, guess what? If if you bought an asset in late 19 or late 2020, early 21, you might find yourself having a difficult time with that 3-year refi strategy, right?
Oh, yeah. And I think 3 years from today, it's still, we don't know what that picture looks like.
We don't. And so we're not going to assume. I mean, we all hope and pray that it's going to be a better capital markets condition, but we're certainly not going to plan on that. Just the same way that we're only planning on cap rate expansion, right? We're not planning on any cap rate compression. That's just conservative underwriting. That's just prudent, and that's just the right way to do it.
Yeah, and to really drive that home is we're truly an under-promise and over-deliver company. Let's talk about the return metrics real quick. And again, these are under-promised and the hopes to over-deliver. But with our conservative underwriting, we also feel this is possible.
Yeah. So what you're going to see in our fund prospectus and PPM. An offering is, an average cash on cash that's in that sort of 6 to 8% range, right? Mm-hmm. Some deals are going to have a year one cash on cash that's only 4%, and some are going to be higher and grow to 8+%. But on average, we're suggesting that 6 to 8% is the right average cash on cash. The IRR range for the fund, again, as a blended model, we're saying is 14 to 16%. And again, that's a conservative range. We feel like that's appropriate given the markets that we're in and the range that we're in. And of course, that becomes an annual return of 18 to 24%, let's say, as an annualized return, and an equity multiple that's in that sort of 1.75 to 2x range. Yeah. And we feel like that is appropriate for the assets and the quality and the risk-adjusted returns that we want to see as investors and that we know our investors in the fund are going to want to see.
Oh, absolutely. Yeah, I can totally agree with that. And again, it's like I stated earlier in one of our other videos on our other podcast, these high returns, they need to be adjusted. The higher the return, the higher probability you're going to call the SEC because you lost your money.
Especially in these times, yeah.
Yeah, and just like the other day, 213 million, I believe, was recalled in Texas because of bank foreclosure. Literally had on the courthouse, just like a sheriff's sale, an apartment building. Actually, 3 of them. Mm-hmm. So we're not doing that, and no. We are underwriting. Insurance right now is big, guys. If you do not properly underwrite your insurance from 2019 until now, there's been 100% increase.
Yeah.
So if you're not catching that, also many states, when you buy a piece of property, the taxes that you got from your broker in your pro forma That was the taxes that was on the piece of property before it was sold. That property was bought for 10 million, you buy it for 30, taxes are going up.
Yeah, that's right. Even in non-disclosure states like Texas, where constant litigation, you still, those are the two. I'm glad you pointed that out, Eddie. Those are the two biggest mistakes I see in underwriting, that for folks who send us deals to help them KP sponsor or look at the deals. It's taxes and insurance. They're just not being sufficiently conservative. They're not going out and getting actual quotes. They're not getting tax opinions from a trusted firm that they work with. And so therefore the pro formas are just grossly inadequate day one.
They are. Yeah. And then another thing is there was so many people that did bridge loans, they never bought a rate cap. It took longer to close the loan, and by their anticipated interest rate on their loan and how long that was going to take and financing fees and stuff like that, they were not put in the underwriting model. So the rate caps got out of hand. The amount of fees related to the financing got way out of hand, and then that's a deal related cost. So ultimately, the more money you put in, the more it drags down returns. It's not like a CapEx budget to where you put in more CapEx and you get a bigger return. That's just a drop in the bucket cost that you don't get back.
That's right. No, you don't.
So, yeah, lots of mistakes made, and we know all about those mistakes, and not because we've been in it, because we're extremely, we study the market. We listen to people. We go to these real estate meetups. You've probably seen us at real estate meetups.
Yeah.
We go to these conferences. Shane, I believe he just spoke last year at one of these conferences, or this year.
Yeah, just a few months ago I did in Dallas. We spoke at a conference there, and sort of state of the market and how are we seeing things right now. And it was a great discussion. It was a great panel, and we obviously are going to do more and more of that and really share our knowledge with others. But yeah, let's kind of go back and talk a little bit more about the fund and who's investing in the fund. What does it all look like? It's a $50 million fund. I feel like the institutional level investors in the fund, I feel like we're going to get probably half or more of that funding money is going to be from larger check writers. And why is that important? Why does that matter? Well, I would say that to, sort of a typical, investor that is going to invest, 50, 100,000, 250,000, and we will have substantial amounts of those investors in our fund as well. But something that's always given me comfort when investing in funds or in deals like this is that there's a whole team of professionals with institutions. There's a whole team of analysts, underwriters, and very astute financial professionals that are drilling into who we are, that are drilling into the assets, that are drilling into the opportunities, the fund structure, before they write that $5 million, $10 million, $20 million check. That there's been a lot of scrutiny and a lot of eyes on it. And to me, that gives me a lot of comfort that's been blessed by that level of professionalism in the investing world.
Yeah, that's so true. And just to take that just a little bit farther, when we're talking about this institutional money that comes in this fund, when we send over our package to an investment firm, an institution, our underwriting is being scrutinized by Wall Street level underwriters, and they're checking boxes on the Wall Street level. I mean, these guys are, they're the Harvard guys, they're the JP Morgans, they are top of the top, and we're under that scrutiny to be able to pass their level. So if we're passing their check boxes, institutional check boxes, then the retail level, they would definitely have a high sense of comfort knowing that this fund's been through it,
Yeah, and not only that, I think it's important to note and to add that our firm has years of experience at that level, right? Where we've received, $5 million checks, $10 million, $13.75 million, $20 million checks from institutional investors. And so we know how they think. We know how conservative they are, and we know how to structure our deals and our opportunities. And frankly, from a performance perspective as well, we know what they look for because we're in those weekly or monthly meetings with them, answering the questions that they're asking us. So we already know now how they think and the types of questions they're asking and looking for, which frankly just makes us better operators.
Absolutely. Yes, for sure.
Because we've been through the ringer already. We've been grilled. We know what they're going to look for before they write that $20 million check. So, no, that's great. I think that's important to note, though, that that's the level. Look, we're investing our own money, right? I mean, it's important that you have sufficient conservatism and you have more upside, and you're protecting your downside risk.
Absolutely.
Right. Rule number one: do not lose capital. Do not lose principles.
No, not at all.
And we keep that. We take that. We take that charge very seriously.
Mm-hmm.
It's
for sure.
Fiduciary responsibility that we hold.
That's right. So, guys, what are we going to buy in this fund? We're looking at, $30 to $50 million assets, up to $70 million assets, 300 to 600 doors at a time, middle market, Class B, a little bit of Class C. We also really like the Class A properties. But one thing we're really looking for during these times, I know everybody's afraid of investing in real estate right now. And those people that's afraid of investing in real estate right now are missing opportunities. We're still finding opportunities and we're still searching opportunities with loan assumptions. We're maintaining a good rate on the interest for a period of time during the time that we hold the property. And then recapitalization deals, keeping the senior debt in place. And those two models right now are keeping us in the market and still buying. We're still looking every single day and we're still finding opportunities. So I would caution every one of you investors that is sitting on the sidelines, retail all the way to into the institutional level. Now is the time to put your money in the market. Inflation is through the roof. There's still the bank scares. Everybody's afraid of the banks, but those are small to middle-sized banks. They're not big banks. The big banks are not falling. This country is not going to fall apart. Real estate will always still be there. And it is important to get your money invested in the hard assets. I would encourage you to bring your money out of the banks, the small to middle banks, and get them into hard assets where you are tied up for at least a long enough period of time to where the market scarcity is out of the way. Yeah.
No, that's pretty good advice. I mean, you shouldn't just have your money sitting in a bank anyway, right? It should be invested somewhere. It should be earning better returns than inflation is taking it away and eroding it from you. So that's important. And I would just add to that, Eddie, that something I've said in every podcast over the last 6 months. I said it in Dallas when I was at that conference speaking. And that is that 2023 is going to be known as the year for those of us who are active, that it's the year of being able to buy at a good basis, right?
Yes.
So everything is in trouble. Interest rates are high. We're extremely picky with everything that we look at. But for example, if we're buying a 2022 asset that was, leased up in early 22, ended construction then, started leasing up, and now we're buying it, and it is $40,000 a door under what new construction can be delivered for today. That's a good basis story, right? Where we are well below replacement cost on what's effectively a 1-year-old asset. I mean, that's an amazing story. If we're, again, that's a kind of outlier, but what if you're in general, if you're $20,000 to $30,000 a door below what average market rate product is going for today? I'm not talking about, inflated prices from 9-12 months ago. I'm talking about what are things worth today and what are we buying them for? This is a great time to make a great basis play. And I don't know that we're going to see that time, past this year. I think you're going to see, better capital market conditions come back in 24. I think you're going to see potential for cap rate compression again. And I think that that sort of balance of buyer-seller market in the scales is going to tip once again towards sellers, at least ever so favorably. And people are going to look back and say, oh, gosh, those a lot of folks picked up a good basis story during 23.
Well, just to build on that, I mean, I've talked to a lot of people, and a lot of people are like, man, 2023, I'm just not sure. I'm just going to sit on the sidelines. I'm just going to kind of wait. And they're not even actively in the market. They're just kind of just hanging on. They got their money in a money market account. They're just sitting around.
Yeah.
And I feel like if you're not in the hunt, if you're not fishing every day, you don't know how the waters are changing. You just don't. So with us being in the market all the time, another thing you've got going on is you got Goldman Sachs and BlackRock, and these big companies that's held these assets, 30, 50,000 assets under management, they're releasing some of these properties. These are properties that nobody's seen before. They've never been on the market for a long period of time because they've been traded in large institutions. Those markets are coming online for us. And I don't feel like you can find that opportunity sitting on the sidelines.
You can't.
That's why we are extremely active, ear to the ground, hunting every day. Like I said, Nick's is in Dallas looking at some properties this week. He's looking for those opportunities. We're going to Dallas next month, and we're going to be looking at opportunities. Mm-hmm. These operators and new syndicators out here and newer companies that's talking about raising all this money, I would really check on their track record and what they're actually doing during this period of time. If they're just sitting back and just raising money for other people's deals, I would caution investing with them. I would invest in a company that is constantly hunting every single day and still active during these times.
Yeah, and has a track record, right? And has
exactly.
proven the ability to perform. Because the one thing, and again, I've said this as well many times over the last few months, but this market, I think, is a market correction that we're seeing because it was overinflated and returns were, they were just coming too easily. And the fundamentals of the business, the sort of what I call the blocking and tackling, and the actual managing those daily, weekly KPIs at the property level, and really understanding how to be a good asset manager, those fundamentals are lost on many operators that really didn't ever have to do that, right? Because they were just relying upon this outsized market inflation that was occurring. And now it's back to the basics of sort of the industry that I grew up in, which is you got to know how to run the asset. You got to know how to manage people. You have to know how to manage the process. And that is where the rubber meets the road in every investment. Yes. And that is really where people really should be focusing. Assets are nice, but who's running them matters more.
Oh, yeah. Operational teams, operational standards are huge.
Yeah, absolutely.
And, those properties that just went down in Texas, two of the biggest things that they're blaming it on, number one, insurance hikes. It got too high. They couldn't operate the asset. There was operational problems within their management staff. And then two is bridge to a actual institutional debt for long term. The rates were too high once they got there. So they bought these properties in some bridge loans. By the time they physically closed on it, property wouldn't cash flow. One of them, occupancy was a problem. That's mismanagement.
Right. 100%.
Just all it is to it.
All there is to it.
It's unfortunate. That's the case.
That's right. And frankly, those are opportunities that our fund intends to capitalize upon.
Absolutely.
And take those assets and turn them around and make them wins for our investors.
Yep. So one more time, who is our investor? Who are we looking for?
We are looking for accredited investors, which if you don't know what the definition of that is, please Google that, look it up. But definitely need to be accredited investors. It's a 506c fund. It's a minimum $100,000 investment is really where we're sort of starting things out. And obviously we are going to be talking to, like we alluded to, family office groups, institutions, and large ultra high net worths that are going to write sort of $1, $5, $10, $20 million checks as well to help us fill this fund up. Like you said, Andy, we don't intend it for it to go for a year before it's filled up. It'll likely be substantially less than that. And so, it's really for folks who are looking for stable risk-adjusted yields in a nice blended fund of assets in markets where the operator focuses their operations.
I'm betting a steak dinner 1 month.
Well, you're on, buddy, and I'll be happy to buy you that dinner.
All right. All right. 1 month, guys. We're going to be full. So jump in now, because I'm telling you, it's going to go fast. Spots are going to be limited. Another thing is I'm going to work on this week getting this thing in a lot of IRA, at least 4 different group, maybe 5 IRA companies. Once I have the paperwork filled out, I will let you guys know what companies. And please monitor all of our social media platforms. So Shane and I both have a Facebook page. We have a LinkedIn page. We also have a company page on Facebook and on LinkedIn. So go check those places out. We got a website, that is hampshire.capital. And then Hampshire Capital on LinkedIn, Hampshire Capital on Facebook. Go check that out, monitor that. Make sure you're seeing this stuff when it's coming out, because I'm telling you, spots are going to run out fast, because I'm not buying this guy a steak.
He knows how much I can eat.
Yeah, absolutely.
All right. Well, thanks, Eddie. Great as always, and look forward to seeing you on the next one.
Yes, absolutely. Thank you for the time, man.
All right.